Probably one of the most difficult things about investing is you can do everything right. You can follow the rules, and let's just say for this instance, they're the right rules. You can do everything right, and you can still lose. This is really intellectually frustrating, especially as you start digging in more, and oftentimes you see some of the worst investments do great during times of just manic rise in the stock market. Right? It's not the best stocks that always rise over time. In fact, people who study the price to earnings ratio and other fundamental information, there's never been any research, not that you have to have research, but basically if you don't know if you're going to own your stock for less than 2 years, 24 months, looking at price to earnings ratio and other type of fundamental information isn't the leading piece of data that you should be looking at. You should actually be looking at the price chart. And that is one of the many reasons why I like looking at price charts, because I don't know how long I'm going to own something. And if there's no data that says that fundamental information can help within the 24-month holding time frame, then all things being equal, even if I do look at fundamental information, price charts and price information can definitely help me. So there's a bit of a tug of war going on in the world right now, and that's something that I that I actually want to point out to you as we come into the last month of the year, which is amazing that we're already in the 12th month for the year of 2015. And that's what I want to do, is spend time with you for a few minutes and just talk about this tug of war that's happening and how it will impact, or how it is impacting and can continue to impact your portfolios regardless of where you live. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme of this weekend, which I already kind of told you, is Tug of War, which of course my brain thinks it's Tug a War, but it's Tug of War. Anyway, so here's my image for you for this weekend. You get your, apparently there's official games of Tug of War. So what is the Tug of War I'm talking about? The first one, and the one I'm going to talk about in this podcast to you, is there's kind of a tug of war going on between the 10-year yields between the U.S. 10-year yield and the German 10-year yield. Now, the blue line on the chart here is the 10-year yield. Now, you can't tell because of the vertical axis what the actual yield is of the 10-year Treasury today, but I will tell you it's 2.27%. 2.27%. The red line on the price chart is the German 10-year yield, and that is at 0.68%. So it's 2/3 smaller than the yield on the 10-year in the U.S. Now, you can see if you look at the chart that right around 2013, the German and the U.S. 10-year yield, they basically kind of did the same thing. They might have been off a few basis points here and there, but they pretty much stuck together. And then in kind of 2012, 2013, they decided to go in separate directions, with the German 10-year yield falling. In fact, it got so low, you can see that in 2015, it almost went negative for a 10-year. And then at the same time, the 10-year in the U.S., let's call it stabilized. Now, the reason this is interesting is because the German bond market is gigantic, and it's one of the largest bond markets in the world. And if you're a global investor, or if you're just an investor and you're looking for yields, now clearly there is no German mark, but it's the German euro or the European euro, kind of the same thing. And you're looking to put some money away for 10 years, the US is paying you 2.27%, and Germany is paying you 0.68%. So what I think is going to happen with this tug of war is I don't actually think someone's going to win, but this tug of war is actually going to bring those yields together. Somewhere they're going to come closer together. Germany is going to be pulled up a little bit, and the US is going to be pulled down a little bit, and they're going to meet somewhere, not exactly in the middle, but somewhere in the middle. Why is this important, and how it affects your stock portfolio? Well, if you're in the US, long-term yields, 10-year plus 10 to 30-year yields, it's very likely they're still going to come down. And if we do have a major or noticeable correction in the stock market over the next 18 to 24 months, which I believe we have kind of in the can, meaning it's going to happen, then it's very likely that people will run or stampede into bonds, and that will push the price up, and that will bring the yield down. Now, the only thing that could go against that is if China at the same time will dump a lot of their own bonds. And what I think is happening lately is China is starting to dump their bonds because they have over $1 trillion of U.S. Treasury bonds. And so when people are rushing into bonds like they did yesterday, because yesterday being Thursday, I'm recording this on Friday, I think at the same time, China's like, look, anytime people are rushing into buying U.S. 10-year plus bonds, let's start selling into that. So this good indicator of seeing how bond prices go up when stock prices go down, I think it's not going to be true, which that's interesting how now we have these major world players. China's a major world player. Germany's a major world player. How that's going to affect how kind of we used to look at the stock market. But as far as this price chart is concerned, I think the bluish purple line is going to come down and the red line is going to go up, and the German and the 10-year yields, the US 10-year yields are going to come together. Now, sticking with yields, now this is not actually a price chart of yields. This is a price chart of junk bonds, the actual price of junk bonds. This specific ticker symbol is HYG. And what I want to just point out is the price is falling. Back here in 2012, where we had the debt level craziness and people got spooked and the stock market fell 24%, we kind of hit this line. Now, intraday or intra-week, it went all the way down here, but it closed here for the week. That's why you see two horizontal lines here. And then if you go up here, you can see, yes, back in 2013, but the price of junk bonds has been falling since the mid part of 2014. So for the last 18 months, the price has been falling right alongside with oil prices. And we've talked about this before, that there's about there's not $500 billion worth of junk bonds with energy, but the energy sector took on $500 billion of debt, with a noticeable amount of that debt being junk, meaning high yield, lower probability of getting of the bond holders getting their money back. So this is moving in, let's call it lockstep with oil, and it'll be interesting to see if this bottoms here at its weekly low. But we also have the intra-week low right here. As oil is selling off, so is the junk bonds, and this is a drag on the stock market, and the stock market's not ignoring it. But I think part of the reason why the stock market is going sideways this year and has been so volatile is because of energy prices. And the commodity index sector has been getting hit pretty hard this year and for the last 4.5 years. So there's so many things at inflection points, but it's kind of staying on the conversation of yield. You have junk bond prices here that are continuing to fall. And yes, if it breaks below this low in 2015, that's a major point. But we've got a major support right here just below it. So I'm keeping my eye on this. And if it just stays around here and bounces around for the next 12 or 18 months, that's fine. Or if it just slowly meanders, I think it's the acceleration that is what I'm keeping my attention on. I mean, the direction is clearly down. That's a 200-day moving average, you see a 200-week moving average there. So the trend is clearly down for the price of junk bonds. And then the last thing I want to show you, this is really interesting. This is a yield curve, and this is a yield curve taking the dividend yield of a 10-year treasury in the U.S. and subtracting the yield of a 2-year treasury. So if a 10-year was yielding 10% and a 2-year was yielding 5%, what you'd see on here is 5. But because we're at 1.25%, that means a 10-year is yielding, let's just say 2.25% for easy math, and a 2-year is yielding 1%. So you have that 1.25. Now, here's what's interesting. If it gets below 0, it is exceptionally likely we go into a recession. If we do, stock markets do not like recessions in the home country. And you can see this back in 2000, we went into it right at the time that the market started crashing, and the market crashed for another 2 years after that. So even when the yield curve starts steepening, that's called the steepening yield curve. The stock market can still be falling. It's when the yield curve comes down here, and let's call it flat when it's at zero, is when things get really, really dangerous for the stock market. Now, I have this other line here, and what I noticed is just at this 1.25 number, there's a strong support there. Way back here in 2001, you could see it bounced off this about 1.25. And then here in 2008, it bounced off 1.25. Again, at the beginning of 2009, it bounced off it. Again, in 2012, it bounced off it. And again, in 2015. So this number has meaning. There's a reason why it bounces off here. And what I'm interested about and what I'm watching is what will happen when it does break below this. I'm guessing it will eventually. I don't know when. Does that create more instability? And that's kind of what's going on with the stock market right now. It's looking at all that's going on in the world. It sees the central banks keeping rates artificially low with zero interest rate policies and negative interest rate policies around the world. It doesn't really want that. The stock market doesn't really want that. It'd rather have a healthy yield curve and yield environment, but it doesn't. And that's why we're getting a lot of this volatility really ever since 2008. But no one ever notices upside volatility. They just call that growth and good things happening. We humans only think of volatility to the downside, but it's actually to both sides. So the yield curve is telling us, especially if it breaks this 1.25, that if it does, we could have more instability in front of us. And it doesn't necessarily mean the market's going to crash. What could very well likely happen is this yield curve breaks below this point and Mario Draghi comes out and prints more money. Or Janet Yellen does something, even if she does raise interest rates this month, or at least announces raising interest rates this month. So what's the takeaway? Why does this matter, and why should it matter to you? Well, the first thing is yields matter. Because they give us kind of an inside look to the stock market and other markets. The bond market is about 4 times bigger than the stock market, so it is played with, and it's on a much bigger playing field than the stock market, and it influences the stock market. And right now, what yields and the yield curve are saying is, hey, we're low, we're artificially low. Germany's really low, which will probably pull U.S. yields even lower. The central bankers of Europe and the U.S. are keeping yields lower. That's pushing the stock market higher. And, hey, by the way, the yield curve is getting flatter, all things being equal. That's not good, especially if it goes flat and you get a higher yield from a 2-year treasury than you do from a 10-year treasury, and that will not be good for the stock market. But we'll keep our eyes on it. I'll keep my eyes on it. And until then, what's most important is the price direction of the stock market. And though we have some volatility, there's a battle of, does it want to go higher? Does it want to go lower? And that's kind of being battled out right now with the S&P and all the other major stock indices in the world, and it is being battled. My guess, and this is just a guess, or my forecast is the central bankers still want the markets to go higher. Ultimately, I think this ends in a fiery crash and lots of money being exchanged from the bottom 98% of people in the world to the top 1 or 2% of people in the world. And we can't stop it. It's sad. It's going to hurt a lot of people. But I do want to make sure you're on the side of the 1 or 2% where the money is getting moved that way. And that's, in fact, what we do with the strategies. Thanks, guys, for being here. And this is just another step in helping you protect your future and secure your portfolio. Until next time, this is RC Peck.